Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to share with you guys probably one of the best dividend paying companies out there, which is actually growing that dividend massively, as well as the business side of things. This is probably one of the best companies and one of the companies that has a wide moat in my opinion. This is probably one of the best out there. So what I'm going to do is I'm going to share with you what the company does. I'm going to explain to you the financials and what I know about the company. They've just reported earnings this week, and when they reported first, they were down about 5%. So we need to look at that and see if there was a massive issue or if it's just Wall Street just being Wall Street. And then at the end, we'll look at the valuations and we'll see if it's buy or sell right now. I do own the company in my portfolio, so I will tell you exactly how much I own, what my average is, and what I will be doing moving forward, inshallah. So if you like this type of content, like I've always said to you guys, you know, it takes a lot of time and effort to put these videos together, so I would genuinely appreciate if you can join us on the Patreon account, where you get access to a lot of things. If you haven't done that already, please join us. Now there are a couple of other companies that have reported, so I will be doing a lot more videos in the next couple of days just to kind of do a quick recap on some of the things that we've seen. Well, the worst one today is UPS have basically reported today, and I think they were down last time I checked about 14-15%. Now, a lot of that is something to do with potentially the company losing Amazon, so or reducing the Amazon delivery side of things to almost to 50%. They haven't said exactly what the customer. They said one of their customers basically is trying to will be reducing their volume basically by 50%. People are assuming is basically Amazon, so we'll see what they say. Now, the company CEO is actually about to go on within the next 40-50 minutes on CNBC to talk about some of these things. So I will be watching that, inshallah. I will let you guys know. The fact that it's down 15% today could be a potential 50% of losing 50% of that with that one company. We then need to look at the bigger picture and see how much of their business is actually represented by that one company, and so on. So there's a lot more to find out, inshallah. I will let you guys know when I have more information, but right now let's go talk about this company. And the company is MSCI. This company, or Morgan Stanley Capital International, is a financial service company that provides investment decisions and support tools, and mainly in the form of indexes, analytics, and portfolio risk management solutions. So they have the indexes side of things. So they've got MSCI and CI world indexes. They've got the emerging markets. They've got the ESG indexes as well. They've got the analytical and risk management side of things. They also have the ESG and basically climate research. So they are in that type, basically that side of the world. There's a lot more information, of course, you can find out about the company, what they do, the ins and outs, the fact that a lot of their ETFs and mutual funds and so on are basically, they run those things. And now what we're going to do is look at basically what the company has reported, and they reported a couple of days ago on the 29th. And what they reported is, in fact that was yesterday, and what they reported is this. Okay, so they beat top line, the bottom line, which is basically the EPS, earnings per share, but when it comes to revenue, they were actually down. So this is based on what Wall Street was expecting, right? This company does not actually guide when it comes to revenue side of things. They don't do that. But look at this, a year over year, it was almost 8% up. But Wall Street decided they're going to come up with their own side of things, or not basically guidelines when it comes to guidance, basically when it comes to this, and they missed that. So that's probably one of the reasons why this stock was down quite a lot. So yeah, nothing. I'm not worried. The fact that year over year, every single year, you want to basically the company to basically that revenue to grow, and that's exactly what this company is doing. One of the things I love about this company is that recurring subscription based kind of revenue side of things, which was up 7.5%. Asset-based fees about 20.8. New recurrence, basically that was slightly down, about just less than 1%. An organic recurring subscription rate growth of almost basically 8%, which is really good, and the retention rate is 93%. So when I look at that, I'm like, okay, there's nothing actually really to worry about. And on top of that, they've actually increased the dividend by 12.5%, which is absolutely amazing for our basically people like myself who are shareholders for this business. And what we now need to do is look at the financials. So we always talk about, is the company making profit? What are they selling? Do they make money? And what is the financial looking like. So that's exactly what we're going to do now. So from $1 billion in 2015 to right now 2.8 in terms of total revenue. Now check this out. They're not spending much in terms of the cost of that revenue. So basically their gross profit is 2.3 billion. Out of the 2.8, they're only spending less than basically about 500 million of that money, which is absolutely amazing. And I love that, the fact that they have that subscription based recurring subscription based kind of thing. This is almost like basically it's a software company. Okay, and their net income, when we check out their net income, as you can see, is at $1.1 billion, which is really great. So the company that actually made about $2.8 billion, and right now that's taking home or more or less net income of $1 billion. Now EPS has been also growing the right direction over the last whatever years. So if we look at basic EPS, $2.05 to right now $14.09, which is absolutely amazing growth over the last 10 years. Now, the other things I want to show you is that is not great about this company is their current liabilities is actually higher than current assets. So if we look at the total current assets of $1.3 billion, and you look at their current asset, for example, okay, is 1.5. So 1.3 against 1.5. So slightly basically has a higher current liabilities, which is not bad at all. It's not a huge difference. But they also do have some free cash flow, which I will show you in a second. And when it comes to total liabilities, though, they have $6.3 billion against total assets 5.4. So they have more liabilities than current assets, and that for that reason the company will have negative shareholder equity. So we will see. Now let's look at the rest of the information that I wanted to share with you guys. So like I said at the beginning, it's financial exchange and data. So basically that they're not a financial company themselves. They don't actually deal with, they're not a bank, basically, let's put it that way. So they are Sharia compliant company, and you can check that on Zoya and so on, and I'll share with you guys at the end. And as you can see here, they are not a huge company, but they are decent. 46 billion basically market cap. In white mode, 1.1 in terms of beta. Now current PE is very high, 42, and the forward PE is about 34. So this tells me based on the 5-year average, the company might be slightly cheaper, but when you look at the forward P, it's about 34. And when you look at the sector, though, the sector median, again, remember the banks do not have a higher PEs normally. Anyway, the financials are quite a little lower. If you look at companies like Visa and MasterCard, they will always have higher PEs in comparison to these banks that are dead. These companies are growing a lot and so on. So dividend side of things is where this company shines. Dividend yield, that's not the dividend yield, that's sort of more or less the market cap. Yeah, that was the wrong formula. 1.22% when it comes to dividend yield. Payout ratio looking about 41%, which is really good. Annually, you get $7.20. Latest increase was almost 13%, so we've already seen that. The 5-year growth rate is 24%. The dividend growth streak is of 9 years. So they have increased it for the last basically 9 years, and the 5-year growth rate was 24%, which is absolutely huge. Now, it's safe, so 61%, $1.3 billion of free cash flow. That's what I was telling you earlier. And then the free cash flow compound annual growth rate for the last 5 years, we're looking about 19%. Now, one of the things they've said in that quarter, basically, they talked about the free cash flow for the basically next quarter increasing from 1.4 I think to 1.8 range, so of $1 billion, which is absolutely amazing. The free cash flow margin, we're looking at about 41%, so 10% is what we normally looking for. Profit margin 38%, operating margin of 53%. We've already seen that how much company actually in terms of gross profit, how much they make. Return on equity is not there now because of the negative shareholder equity that we've just seen, or the current liabilities, if you like, being higher than current assets, which is something that we've just seen. Okay, so this and this are more kind of linked. Return on invested capital 41%. Net income margin of the last 5 years, we're looking at about 38%. Total return in the last 10 years is 28%, which is absolutely huge. Revenue growth, in the last 5 years, we're looking at about 13%. EPS growth, we're looking at about 18%. Now, in terms of valuation side of things, This is where basically people kind of disagree, because some are saying it's cheap, some are saying it's expensive. I'll tell you exactly what I think. Now, they're expecting the earnings to grow next year about 13%, revenue to grow about 9%. Now, if we go back here, we can just quickly check for the rest of the years coming up, inshallah. So we got about this year's 2025. So they've just finished basically Q4. So basically this is what they're expecting in 2025, and 2026 we're expecting. So this is December 2025. So this is this year basically. December 2026 we're expecting about 13%. 12%, so double digits every single year in terms of year-over-year growth when it comes to EPS, which is absolutely amazing, and almost double digits when it comes to revenue side of things. So absolutely nothing to worry about in that side of things. As you can see, Morningstar is actually saying $530 per share, 12% premium right now. According to Simply Wall Street, they are saying it's slightly also 5% overvalued. $565 per share is where they think the price should be. As you can see, it's $590 right now. Target price for tip rack is actually $676, so it's slightly bullish, 14% upside from where we are. A strong buy again, very bullish there. And average price for Seeking Alpha $656. 10%, almost 11% upside from where we are. These guys use basically Wall Street analysts, so they kind of average it out, and Seeking Alpha is actually saying it's a buy. With regards to Sharia compliance side of things, absolutely nothing to worry about. Both basically, this is one of the reasons I really own this company. I like the company because that Sharia, like, I don't have to worry about the interest-bearing debt in terms of interest-bearing securities, and as well as the overall business. I can just buy and hold it for a very long time, and that's exactly what I intend to do. I'll give you more information in a second. But they're buying back their own shares, and I think they've said they're buying almost $1 billion of basically their shares in the next year or so. So overall, very good business. They're buying back their own shares. They might be a little bit overvalued right now, and generally they are basically debt now needs to come down a little bit. So they should have more current assets, and basically total assets than actually current liabilities and total liabilities. So just a couple of more things. The first one is to look at currently they basically taken to valuations from these companies. So Morningstar we've already seen, Wall Street we've seen, Seeking Alpha we've already seen. I used to multiples valuation to compare similar sort of companies in the same sort of industry, and then discounted cash flow model, which gave me 614. When we average six of them in fact, that gives us 606. So currently it's 590, so not far off. It's about 3%. Now you might think, you know what, this company might be a little bit volatile or whatever, and then you always need a bit of margin of safety. Okay, so either 5% if you think the company is really safe, or 10% just to be on the safe side. Okay, so $550 basically is what I would say will be a good entry point if you're looking at this company. Again, don't take my word for it, do your own research, make sure you understand how this business operates and so on. So a couple of more things I want to share with you guys right now is compare this company with the rest of similar sort of a company. So we've got FactSet, and here we've got an S&P Global and the Nasdaq, for example. So all three of these basically companies are very similar, especially SPGI. So as you can see here, we're looking at the total return in the last 3 years. So this company is about 8, let's call it 16%. Basically underperformed the S&P 500. This one is more or less the same. S&P Global overperformed, basically similar to the S&P 500, about 30, and the Nasdaq is the outperformer here. The last 5 years, Nasdaq is about 127, the company is 113, and you can see the S&P basically at 500 as well as S&P Global. So it's done well in the last 5 years. Basically, outperformed these three here, but that Nasdaq still outperformer. Now, the last 10 years is 1,150% total return, which is absolutely amazing. Look at the S&P 500. Look at everyone else. Okay, the closest to all basically is S&P and Global and the Nasdaq. But look at the last 10 years. So if you bought this company 10 years ago, credit to you guys, okay, because you're doing an absolutely amazing job. And the fact that they are basically increasing a dividend every single year. By the way, this includes total return, includes dividends and everything else. So overall, I genuinely think this is one of the the best companies out there. Still Sharia, of course, it is Sharia compliant. Otherwise, I wouldn't have owned it in my portfolio. So what I'm going to do now is show you what I own, and I wish I bought more. I own basically 10 shares, and is right now is worth £4,742, and that's about 16% up, or £662. If you watch videos, I think maybe this time last year I was talking about this company, the fact that they were undervalued, and alhamdulillah, look at it right now, is doing a really good job. My average is $516 per share. Right now is $590, not far off, or $407 a pound overall. And as you can see, like I said, I'm up about 16%, which is really good. So overall, really great company. What am I doing now? I will not be adding to it until at least it hits my target with my average price, because I'm happy with what I own right now. And there are other opportunities, other companies that I would like to own. So of course, for now, I'm just going to leave it alone and collect that dividend every single week, every single month, or quarter, and leave that company alone. So yeah, that's the company I want to share with you guys. If you enjoyed this type of content, like I said to you guys, don't forget to join us to the Patreon account, where you get access to the family portfolio and loads of other things, including the Discord. Inshallah, have a wonderful day. Assalamu Alaikum.